Hello everyone, how's it going? In this video, we will talk about Mullen, trading under the ticker symbol MULN. As the market has been very volatile and active over the past few weeks, and the future outlook looks uncertain, we will go through the latest fundamentals, the price actions, and my analysis as well as the recommendation to help you make better decisions. Before the video begins, I'd just like to state a brief disclaimer about what this video should be about and what it shouldn't be. What is presented in the video is going to be my opinion or interpretation on how things are and how things should or will be. They're not considered to be investment advice and should be watched for entertainment purposes for the most part. They may be able to help you make better, more educated decisions, but should not be used as the sole material for decision making. Most of my analysis is done in the immediate past or just a few days before the uploading of the video, and a price action may no longer reflect the price action that you see on the chart by the time the video is uploaded, but it's always useful as a tool to analyze the current momentum. Also, the analysis will try to cover the stock as comprehensively as possible, and it'll talk about more factors than just the latest news or the price actions. For example, the company's financials, the stock market trends, the long-term perspective, and the shareholder behaviors are just some of the things that we will go through that will affect the timing, the quantity, and the actual decision regarding this stock. Since most viewers are watching my videos for the first time, it's important for them to consider all the factors. So with that being said, let's begin with today's video. So Mullen operates in the EV manufacturing, distribution, and the marketing areas. It acts as a holding for several brands and companies that they have purchased along the way. The company first began operating in 2014 as a successor to a company called Coda Automotive. Another previous venture from the same founder was Mullen Motorcars. It has developed the Mullen GT, one of the world's earliest EV supercars in the market back in 2007. Overall, it's fairly convincing to say that Mullen has been a veteran in the field, and that at least we can say that they have been around for a long period of time. But the question is whether they have the means to stay in the game. The sector has been known to be highly capital intensive and relies on other industries that may also not be fully mature in their functioning and development. There are also long-term challenges of keeping the valuation of the multiplier as high as possible, avoiding the classification of car or industrial operators. The recent price action has seen Mullen share price reaching around 31 cents, down by more than 40% compared to the peak of the stock. The price movement seems to be influenced by the market mood in general and not just towards Mullen itself. The recent news have been positive to Mullen, which also demonstrate that even good news are not able to stop the ongoing trend, but may be able to slow it down, or to at least confirm some kind of support levels. So Mullen fell as low as 26 cents recently, and it is very encouraging to see it go back as high as 33 cents before maintaining itself around 31 cents. Overall, the short-term price action shows that the shares are slowing down their sell-off or the retracement, and that the same force that pushed it upward has now decided to regroup a bit before deciding whether and when it should go up. And in terms of the long-term price action trends, despite the recent upward momentum, the company has been having a mostly bearish trend over the past 5 years, having traded between $5 and $10 over the years before peaking around $15 and finally falling to the penny stock levels. What this may tell us is that Mullen is greatly affected by the ongoing stock trends, and that its own fundamental weaknesses definitely didn't help. So this assessment recently started to change, but it hasn't really reached a convincing turning point yet. And to a point, it still kind of explains why Mullen for the market is a stock that I would recommend to trade instead of investing in, regardless of the recent distribution contract, the short squeeze, and the interest surrounding the company. For the most part, people want to scalp the stock and to make a quick gain in a matter of weeks from the short squeeze, not necessarily yielding dividends from its car sales in a matter of years or even decades. With that being said, I also want to add that things may move very quickly and significantly in a young sector like electric vehicles. So investing in Mullen should not be crossed off completely. I'm just saying that right now the conditions are not met for us to put money into this company for years without changing the size of the position. So the online communities, along with media outlets, are relatively skeptical and then hopeful about the company regarding its capacity to become ever profitable, and is also uncomfortable with the lack of transparency regarding who their commercial partners and clients might be, even though they have themselves promised to disclose those information. Now, of course, there's still a pocket of resolute optimists who believe that whatever Mullen has for them is good. If it's bullish, they will realize gains. If it's bearish, they're just going to have a better opportunity to dollar average cost in. So in the recent days, I would say that given that there were some good news from the CEO regarding sales to the military and so on, there has been some renewed optimism in the stock, or renewed upward speculation in the stock. And this slowly but surely began to turn the tide of the previous little sell-off from 50 cents to 26 cents. It has given some confidence back, but I'm not sure if this is enough to make it continue up. So overall, Mullen is commented online, mostly because of its volatilities. It has, a few occasions where it triggered a lot of discussions, or just the standard press releases from Mullen itself. The speculations tend to come from the original price volatilities, and then it's going to spread to additional demand or offer. It depends on the situation. And then it also, people try to develop a public discourse to start supporting what they see on the chart and not the other way around. Regarding the macroeconomic trends, they remain challenging. The trends within the EV sector and the growth stocks have been under pressure for some time. It began, I would say, in the early 2021, and then it started to accelerate in 2022. The increasing interest rates, the capital flight back to other options, the conflicts around the world, they're all things that definitely don't help the industry and also don't help the narrative around Mullen. An additional concern is regarding the supply chain issue. This would affect all the EV companies because there are some components that are crucial for the completion of the car, but at the same time, I want to say they're maybe not made in just one factory around the world, but they're made in places that are currently not really moving the merchandise around. So if that's the case, then EV companies may have issues, and then they may have to postpone when they're going to roll out their models. And the same goes for Mullen. Also, it's not a secret to assert that one of the most important factors influencing the course of EV is Tesla, and also its CEO Elon Musk. Recently, things haven't always looked very well on that side, and in a way, it could also affect the upward momentum of the company overall. With that being said, let's also take a brief look at the company's financials. Regarding the cash balance, it has been increasing on a year-to-year basis, which decreases somewhat the liabilities by reducing for more than 13 million, but it also reduced the cash reserves from 105 million to 84 million. It doesn't mean that it went entirely to the liabilities, obviously. Overall, it shouldn't be a big issue. So I wouldn't say that this in by itself is suggesting for additional dilutions. And regarding the liabilities, recently they have removed 13 millions off their balance sheet, which is excellent news. I mean, this would increase their chance of surviving over time of going concern. But at the same time, they also have to watch out whether their operating losses are also eating the cash balance away, in which case dilutions, or additional debts might be required. The profitability remains one of the biggest issues for Mullen because there's no revenue since the beginning of 2021. The research and development has been increasing, which is good, but it's also eating money away. So I would say that they're trying to keep things on top, but so far it's not really helping. And hopefully this is going to get partially alleviated with the iGo distribution contract in Europe. So basically the financials of Mullen are showing us that the big picture of the company is doing fine, is doing decent. They're doing their best to stay afloat, to control the cash levels, and to keep the expenses low if and when possible. But still, they need to make something happen very soon regarding their operations. Otherwise, we will not be able to completely omit dilutions or additional debts to be taken on. The clientele is mostly retail clients, individuals like you and me, if we have enough dollars, if we have enough money to buy the EVs. With that being said, their EVs are relatively more affordable compared to companies like Tesla or Lucid or NIO. It's aiming at the medium and high-end clients. It also has a second line of clientele. It might be, it might just be temporary, but still, it's worth to mention. The iGo cars are designed for commercial and freelance businesses that are in parcel and food transportation. Regarding the shareholders, they're mostly retail, which means that they tend to be volatile and reactive to the short-term price actions, which makes Mullen a good stock to trade and to speculate in the short term. But there are some institutional shareholders, but I think that it's not in significant number enough to change my overall view that Mullen is good for trading, but not for the long-term holding and investing. And at the same time, I would say that the lack of investment from institutional participation, it can also mean that there is little trust on their side. This would affect our decision to determine if we should be buying the stock to be, to be sold within a few days or within a few years or decades. Right now, it's more like within at least or at the utmost a month. And then there's also the catalyst of short squeeze. In my opinion, I would say that it's definitely a possibility. It's a real possibility. And to the very least, it's triggering some people and motivating them to buy additional Mullen shares. Doesn't mean that it's going to happen for sure. There's nothing for sure in the real world. But at the same time, I would say the probability there is significant. It might be 40%, it might be 60%. But it's, in my opinion, it's enough for Mullen's short squeeze to be a thing. It's something that could truly happen. And we have to reflect on that. So regarding the investor profile, they tend to be diversified. They might be willing to take risks. They believe in the long-term development and relevance of the sector. And by ricochet, they're also believing in Mullen. They believe in the upcoming fundamental news to be very good for the company. And finally, they also think that the short squeeze is not just a rumor. It's something that's, 50% or more of probability that it's going to happen. So overall, my recommendation is that we definitely have to wait for this week's trading sessions to see whether Mullen has now left the overall retracement back from 55 to almost I want to say 25 cents. So if that's the case, then definitely consider to buy in. If you see that, oh, we're now Wednesday and the stock has been able to hold the 30 cents level, this, in my opinion, is a bullish sign. And the overall recommendation for the exposure is between 0.5 and 1% of your portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.